Question 1. Quality control measures reveal a junior associate has consistently overlooked a specific disclosure requirement in client onboarding documentation, potentially leading to a breach of regulatory obligations. The associate appears unaware of the oversight. Option A. Immediately report the oversight to the firm's compliance department for their assessment and guidance. Option B. Advise the junior associate to correct the documentation without mentioning the potential regulatory implications to avoid alarming them. Option C. Directly inform the client about the potential disclosure breach and ask for their clarification. Option D. Discuss the junior associate's performance and the specific oversight with other senior team members to gauge their opinion. The correct answer is A. Immediately report the oversight to the firm's compliance department for their assessment and guidance. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the obligation to report potential regulatory breaches. The firm's reputation, client trust, and legal standing are all at risk. Navigating this requires a nuanced understanding of both ethical duties and regulatory requirements, demanding careful judgment to balance competing interests. Correct approach analysis. The correct approach prioritizes immediate, confidential escalation to the firm's compliance department. This aligns with best professional practice by ensuring that the matter is handled by designated experts who understand the relevant regulatory framework and can initiate appropriate internal investigations and external reporting if necessary. This method upholds client confidentiality by preventing premature or unauthorized disclosure while fulfilling the firm's regulatory obligations in a structured and compliant manner. It demonstrates a commitment to integrity and adherence to the JBS hiring assessment tests, implied regulatory environment, which would likely mandate such internal reporting mechanisms for suspected misconduct. Incorrect approaches analysis. One incorrect approach involves directly confronting the client with the suspicion without prior internal consultation. This is a significant regulatory and ethical failure. It breaches client confidentiality by disclosing internal suspicions and could lead to the client taking actions to conceal the alleged breach, thereby obstructing any potential investigation. Furthermore, it bypasses the firm's established compliance procedures, which are designed to ensure consistent and legally sound handling of such matters. Another incorrect approach is to ignore the observation, assuming it is a minor issue or not within the firm's purview. This constitutes a failure to uphold professional responsibility and potentially a breach of regulatory obligations. Many regulatory frameworks require firms to have systems in place to identify and report suspicious activities. Ignoring such a red flag could lead to severe penalties for the firm and individuals involved, as it demonstrates a lack of due diligence and a disregard for compliance. A third incorrect approach is to discuss the observation with colleagues outside of the compliance department before reporting it. This risks wider, unauthorized disclosure of sensitive client information and potential suspicions, further compromising confidentiality and potentially creating a hostile environment, or influencing the perception of the situation before it has been properly assessed by the appropriate internal channels. It also undermines the integrity of the internal reporting process. Professional reasoning. Professionals facing such situations should follow a clear decision-making framework. 1. Identify the potential issue and its implications. 2. Consult internal policies and procedures regarding reporting and confidentiality. 3. Immediately escalate the concern to the designated compliance or legal department. 4. Avoid any direct communication with the client or unauthorized discussion with colleagues until instructed by compliance. 5. Cooperate fully with the internal investigation process. This structured approach ensures that all actions are compliant, ethical, and protect the interests of all parties involved, including the firm and its clients. Question 2. System analysis indicates that a client who has historically expressed a conservative investment philosophy is now requesting a significant allocation to a highly speculative asset class due to recent media attention. The financial advisor has reviewed the client's financial plan and believes this allocation is inconsistent with their stated long-term objectives and risk tolerance. What is the most appropriate course of action for the financial advisor? Option A. Discuss the risks and potential downsides of the proposed investment with the client. Explain how it conflicts with their established financial plan and risk profile, and propose alternative strategies that align with their objectives while potentially capturing some of the client's interest in growth. Option B. Proceed with the investment as requested by the client, but ensure detailed notes are made in the client file, documenting the advisor's reservations and the client's insistence. Option C. Immediately execute the client's requested investment to honor their directive, as the client is ultimately responsible for their financial decisions. Option D. Politely decline the client's request, stating that the investment is too risky and not in line with their profile, without further explanation or offering alternatives. The correct answer is A. Discuss the risks and potential downsides of the proposed investment with the client. Explain how it conflicts with their established financial plan and risk profile, and propose alternative strategies that align with their objectives while potentially capturing some of the client's interest in growth. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the advisor's fiduciary duty to act in the client's best interest. The advisor must navigate the client's potential lack of full understanding of the implications of their request, the potential for misaligned incentives, and the regulatory obligation to provide suitable advice. Careful judgment is required to balance client autonomy with the advisor's responsibility to ensure the client's financial well-being and compliance with regulatory standards. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing the client's best interests, a core tenet of fiduciary duty. This involves a thorough understanding of the client's financial situation, objectives, and risk tolerance. By explaining the risks and benefits of the proposed investment and offering alternatives that align better with the client's overall financial plan, the advisor fulfills their regulatory and ethical obligations. This proactive engagement ensures the client is making an informed decision, not just a reactive one based on potentially incomplete information or short-term sentiment. This aligns with the principles of client care and suitability expected under relevant financial services regulations. Incorrect approaches analysis. One incorrect approach involves immediately executing the client's request without further inquiry. This fails to uphold the fiduciary duty to act in the client's best interest. It bypasses the crucial step of assessing suitability and could lead to an investment that is not appropriate for the client's circumstances, potentially exposing them to undue risk or failing to meet their long-term goals. This could be a breach of regulatory requirements concerning suitability and client advice. Another incorrect approach is to dismiss the client's request outright without understanding the underlying reasons or providing a reasoned explanation. This demonstrates a lack of client engagement and respect for their autonomy. While the advisor may believe the request is unsuitable, a professional approach requires a dialogue to educate the client and explore their motivations. Simply refusing without explanation can damage the client relationship and may not address the client's actual needs or concerns, potentially leading them to seek advice elsewhere or make unsuitable decisions independently. This can be seen as a failure in client communication and a potential breach of professional conduct standards. A third incorrect approach is to proceed with the investment solely based on the client's insistence, while internally documenting the advisor's disagreement. While documentation is important, it does not absolve the advisor of their primary responsibility to provide suitable advice. If the investment is demonstrably unsuitable, proceeding with it, even with documentation, is a failure to act in the client's best interest and could still lead to regulatory scrutiny and ethical breaches. The documentation serves as a record, but it does not rectify the initial failure to provide appropriate guidance. Professional reasoning. Professionals should adopt a client-centric approach that balances client wishes with regulatory and ethical obligations. This involves active listening, thorough due diligence, clear communication of risks and benefits, and offering tailored recommendations. When a client's request appears misaligned with their best interests, the professional's role is to educate, explore alternatives, and guide the client towards informed decisions, rather than simply complying or refusing. This process ensures both client satisfaction and regulatory compliance. Question 3. Risk assessment procedures indicate that a significant piece of unverified news regarding a major competitor's financial health has surfaced and is circulating among a small group of industry contacts. This information, if true, could materially impact the market valuation of several listed securities the firm's clients hold. What is the most appropriate immediate course of action for the firm? Option A. Share the unverified information with key trading personnel to allow them to position client portfolios defensively. Option B. Disseminate the information to all clients immediately, as it is potentially market-moving and clients should be informed. Option C. Instruct all employees to disregard the information and continue with normal business operations. Option D. Initiate an immediate internal investigation to verify the accuracy and materiality of the information before any external communication. The correct answer is D. Initiate an immediate internal investigation to verify the accuracy and materiality of the information before any external communication. Explanation. Scenario analysis. This scenario presents a challenge in balancing the need for timely information dissemination with the regulatory obligation to ensure accuracy and prevent market abuse. The firm must act swiftly to address potentially market-moving news while adhering to strict disclosure rules and avoiding the premature release of unverified information. The professional challenge lies in navigating the gray area between proactive communication and regulatory compliance, where a misstep could lead to significant legal and reputational consequences. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing regulatory compliance and market integrity. By initiating an internal investigation to verify the information before making any public statement, the firm adheres to the principle of accurate and timely disclosure as mandated by relevant financial regulations. This process ensures that any subsequent communication is factual, thereby preventing market manipulation and protecting investors. This aligns with the duty of care owed to clients and the broader market. Incorrect approaches analysis. One incorrect approach involves immediately releasing the unverified information to the market. This constitutes a failure to comply with regulations requiring accurate disclosures and could be construed as market manipulation or insider dealing if the information is subsequently found to be false or incomplete. It breaches the ethical duty to act with integrity and diligence. Another incorrect approach is to ignore the information entirely, assuming it is unsubstantiated. This is a dereliction of duty, as firms have a responsibility to investigate credible, potentially market-moving information. Failure to do so could lead to the firm being unaware of significant events impacting its clients or the market, violating regulatory oversight requirements, and potentially exposing the firm to liability. A third incorrect approach is to communicate the unverified information internally to a select group of employees without a clear need to know or a robust control mechanism. This creates a significant risk of insider trading, as those employees could act on the information before it is publicly disclosed, leading to severe regulatory penalties and ethical breaches. Professional reasoning. Professionals should adopt a structured decision-making process when faced with potentially market-moving information. This involves 1. Acknowledging the information and its potential impact. 2. Immediately initiating a verification process involving relevant internal departments, e.g., compliance, legal research. 3. Assessing the materiality and veracity of the information. 4. Consulting with compliance and legal teams to determine the appropriate disclosure strategy in line with regulatory requirements. 5. Communicating the verified information to the market in a timely and accurate manner, or taking appropriate action to manage the situation if the information is false or misleading. This systematic approach ensures that actions are both compliant and ethically sound. Question 4. Compliance review shows that a senior associate in the Wealth Management Division has identified a series of complex international transactions for a long-standing high-net-worth client that appear unusual given the client's stated investment profile and risk tolerance. The associate has gathered initial documentation, but is hesitant to proceed with a formal suspicious activity report, SAR, due to the client's significant business relationship with the firm. The associate is considering several courses of action, which approach best aligns with regulatory requirements and professional best practice. Option A. Discuss the concerns directly with the client to seek clarification on the nature of the transactions before taking any further steps. Option B. Immediately file a SAR with the relevant authorities, detailing all observed anomalies and the rationale for suspicion. Option C. Defer reporting the suspicious activity, prioritizing the client's business relationship and assuming the transactions are legitimate until proven otherwise. Option D. Conduct a more in-depth investigation into the source of funds and the ultimate beneficial owners of the entities involved in the transactions, and consult with the Money Laundering Reporting Officer, MLRO, before deciding on further action. The correct answer is B. Immediately file a SAR with the relevant authorities, detailing all observed anomalies and the rationale for suspicion. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. The firm must navigate the delicate balance of protecting client information while adhering to anti-money laundering (AML) regulations. The professional's judgment is critical in determining when suspicion crosses the threshold into a reportable event, avoiding both overreporting, which can be burdensome and damage client relationships, and underreporting, which carries significant legal and reputational risk. The correct approach represents best professional practice because it prioritizes a thorough, evidence-based assessment before escalating. This aligns with the principle of proportionality in regulatory compliance, ensuring that reporting is reserved for genuine suspicions. By consulting with the MLRO, the professional demonstrates adherence to internal procedures and leverages specialized expertise, which is a cornerstone of effective AML compliance. This process ensures that any suspicious activity report, SAR, filed is well-founded, meeting the legal standard for suspicion and minimizing the risk of unfounded accusations. This approach upholds both regulatory requirements and professional integrity. An incorrect approach that involves immediate reporting without further investigation fails to meet the standard of reasonable suspicion. It can lead to unnecessary regulatory scrutiny and damage the firm's reputation for discretion. This approach also disregards the internal escalation procedures designed to ensure reports are accurate and well-supported. Another incorrect approach, which involves ignoring the transaction due to the client's importance, represents a severe breach of regulatory and ethical obligations. This constitutes a failure to comply with AML legislation, specifically the duty to report suspicious transactions. It also demonstrates a lack of professional integrity and a disregard for the firm's compliance framework, potentially exposing the firm to significant penalties and reputational damage. A third incorrect approach, which involves discussing the suspicion with the client before reporting, is a direct violation of tipping-off provisions within AML regulations. This action can alert the suspected money launderer, allowing them to conceal or move illicit funds, thereby frustrating law enforcement efforts and undermining the entire AML regime. This is a critical regulatory and ethical failure. The professional decision-making process should involve a systematic evaluation of the facts and circumstances. When a potential red flag is identified, the professional should gather all relevant information, assess the transaction against known risk factors, and consult internal policies and procedures. If suspicion persists after this initial assessment, the next step is to escalate the matter to the designated compliance officer or MLRO for further review and guidance. This structured approach ensures that decisions are informed, defensible, and compliant with regulatory expectations. Question 5. Stakeholder feedback indicates a perception that the firm sometimes prioritizes the ease of implementation of financial solutions over a deep, individualized assessment of client needs. In a scenario where a client presents with a complex financial goal that could be addressed by several different types of investment products, what is the most appropriate best practice approach for an advisor? Option A. Conduct a comprehensive review of the client's financial situation, objectives, and risk tolerance, and then identify and recommend the most suitable product from a broad range of available options, clearly explaining the rationale for the recommendation. Option B. Inform the client that further internal research is required and delay the recommendation until a complete analysis of all possible product types has been performed. Without providing an interim update or guidance, Option C. Immediately recommend a product that the firm has a strong existing relationship with and is familiar with its features, as this will ensure a smooth and efficient implementation process for both the client and the firm. Option D. Present the client with a list of all potential product categories that could address their goal, allowing them to choose which one they believe is most appropriate after a brief overview of each. The correct answer is A. Conduct a comprehensive review of the client's financial situation, objectives, and risk tolerance, and then identify and recommend the most suitable product from a broad range of available options, clearly explaining the rationale for the recommendation. Explanation. This scenario presents a professional challenge because it requires balancing the immediate needs of a client with the long-term integrity of the firm's advisory services and adherence to regulatory expectations. The firm must demonstrate that its recommendations are driven by the client's best interests, not by internal incentives or a desire for expediency. Careful judgment is required to ensure that the proposed solution is genuinely suitable and not merely the easiest or most profitable for the firm to implement. The correct approach represents best professional practice because it prioritizes a thorough, objective assessment of the client's situation and objectives before proposing any solution. This aligns with the fundamental ethical duty of acting in the client's best interest, as mandated by regulatory frameworks such as the Financial Conduct Authority, FCA, Principles for Businesses, specifically Principle 6, Customers' Interests, and Principle 7, Communications with Clients. It also reflects the professional standards expected by bodies like the Chartered Institute for Securities and Investment (CISI), which emphasize competence, diligence, and integrity. By conducting a comprehensive review and considering all viable options, the firm demonstrates a commitment to providing suitable advice, thereby building trust and maintaining its reputation. An incorrect approach that involves immediately recommending a product the firm is familiar with and has a strong relationship with, without a full understanding of the client's unique circumstances, fails to meet the duty of care. This could lead to unsuitable advice, potentially breaching regulatory requirements regarding suitability and client needs. It also risks violating ethical obligations to act with integrity and place the client's interests first. Another incorrect approach, which is to delay the recommendation until further internal research is completed without communicating this to the client, demonstrates a lack of transparency and potentially poor client service. While thoroughness is important, indefinite delays without client communication can erode trust and may not align with regulatory expectations for timely and effective advice. A third incorrect approach, which is to present a range of products without clearly articulating which is most suitable based on the client's specific situation, can overwhelm the client and fail to provide the clear, actionable guidance they expect. This approach may not adequately demonstrate that the firm has undertaken the necessary analysis to identify the most appropriate solution, potentially falling short of the regulatory requirement to provide advice that is suitable for the client. The professional decision-making process for similar situations should involve a structured approach. First, fully understand the client's objectives, risk tolerance, and financial situation. Second, identify potential solutions that align with these factors. Third, conduct a thorough due diligence on each potential solution, considering its suitability, costs, and benefits. Fourth, clearly articulate the recommended solution, providing a robust rationale that links it back to the client's stated needs and objectives. Finally, ensure transparent communication with the client throughout the process. Question 6. The performance metrics show a significant increase in revenue generated from new client acquisitions, primarily driven by a specific product line. However, internal reviews indicate that a disproportionate number of these new clients are being onboarded with this product, without a comprehensive assessment of its suitability for their individual financial circumstances and risk tolerance, potentially due to the aggressive sales targets associated with this product. What is the most appropriate course of action for the firm's compliance and management teams? Option A. Implement additional disclosure forms for clients purchasing this product without altering the sales targets or the underlying sales process to mitigate potential future complaints. Option B. Immediately halt all sales of the product in question and conduct a full internal audit of all recent client acquisitions, while simultaneously reviewing and revising the sales incentive structure for this product to better align with client suitability requirements. Option C. Focus on reinforcing the existing sales training materials, emphasizing the importance of client suitability, but allow the current sales targets and incentive structures to remain unchanged. Option D. Acknowledge the strong performance and instruct sales teams to continue their current practices, with a directive to ensure all sales are technically compliant with existing regulations, assuming no explicit violations have occurred. The correct answer is B. Immediately halt all sales of the product in question and conduct a full internal audit of all recent client acquisitions, while simultaneously reviewing and revising the sales incentive structure for this product to better align with client suitability requirements. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent tension between achieving stated performance objectives and adhering to regulatory requirements designed to protect investors and market integrity. The firm's incentive structure, while intended to drive results, creates a potential conflict of interest if it encourages practices that could be construed as misleading or manipulative, even if not explicitly illegal. The challenge lies in identifying and mitigating these risks proactively, ensuring that the pursuit of performance does not compromise ethical conduct or regulatory compliance. Careful judgment is required to balance business objectives with the firm's fiduciary duties and regulatory obligations. Correct approach analysis. The correct approach involves a thorough review of the performance metrics and the underlying behaviors that generated them. This includes scrutinizing the sales practices, client suitability assessments, and disclosure procedures associated with the products or services contributing to the high performance. The focus should be on understanding how the performance was achieved. If the review reveals that the performance was driven by practices that could be deemed aggressive, misleading, or not fully aligned with client best interests, then immediate corrective action is warranted. This action would include reinforcing training on compliance, potentially adjusting incentive structures to de-emphasize volume over suitability, and enhancing supervisory oversight. This approach represents best professional practice because it prioritizes regulatory compliance and ethical conduct over short-term performance gains. It aligns with the principles of treating customers fairly and maintaining market integrity, which are fundamental to the regulatory framework governing financial services. Specifically, it addresses potential breaches of conduct rules that require professionals to act with due skill, care, and diligence, and to act in the best interests of clients. Incorrect approaches analysis. One incorrect approach would be to dismiss the concerns raised by the performance metrics, attributing them solely to exceptional market conditions or individual sales talent. This fails to acknowledge the potential for systemic issues or the encouragement of inappropriate behavior by the incentive structure. This approach risks regulatory scrutiny for failing to adequately supervise staff and for potentially allowing practices that violate client protection rules. It demonstrates a lack of due diligence and a disregard for the firm's responsibility to ensure compliance. Another incorrect approach would be to implement superficial changes, such as a minor tweak to reporting, without addressing the root causes of potentially problematic sales practices. This approach is insufficient because it does not resolve the underlying conflict between performance incentives and regulatory obligations, may create a false sense of compliance while the problematic behaviors continue, leading to more significant regulatory sanctions and reputational damage. This demonstrates a failure to implement effective controls and a lack of commitment to genuine compliance. A third incorrect approach would be to focus solely on the legality of the actions, without considering the ethical implications or the spirit of the regulations. While actions may not be explicitly illegal, they could still be considered unethical or detrimental to client trust and market fairness. This narrow interpretation of compliance can lead to a culture where bending the rules is acceptable, ultimately undermining the firm's long-term sustainability and reputation. It fails to uphold the broader principles of professional conduct and fiduciary responsibility. Professional reasoning. Professionals should adopt a proactive and principle-based approach to performance management. When performance metrics raise questions, the first step is to investigate the driver's of that performance, not just the outcome. This involves a critical assessment of the processes, behaviors, and incentives that led to the results. Professionals should ask, is this performance sustainable and achieved in a manner consistent with our regulatory obligations and ethical commitments? If there is any doubt, a deeper dive is necessary. This includes engaging compliance and legal departments, reviewing client files, and assessing the appropriateness of incentive structures. The decision-making process should prioritize client well-being, regulatory adherence, and the long-term reputation of the firm over immediate financial gains. This involves a continuous cycle of monitoring, evaluation, and adjustment to ensure that performance is achieved responsibly. Question 7. Market research demonstrates that a significant portion of potential clients are choosing competitors due to faster onboarding times. To remain competitive, the firm is considering streamlining its Know Your Customer (KIC) and anti-money laundering (AML) procedures. Which of the following approaches best balances the need for competitive speed with regulatory compliance? Option A. reducing the scope of required documentation for all new clients, accepting client self-attestation for source of wealth and funds without independent verification to significantly cut down processing time. Option B. Developing a comprehensive digital onboarding platform that automates identity verification using reliable third-party data sources and streamlines the collection of necessary documentation, while ensuring that all data is subject to rigorous internal review and that exceptions trigger manual oversight by experienced compliance officers. Option C. Implementing a tiered due diligence system where enhanced due diligence is only applied to clients explicitly flagged as high risk by an automated system, and standard due diligence is deemed sufficient for all others, even if initial risk indicators suggest otherwise. Option D. Delegating the final approval of all KYC/AML documentation to entry-level staff who have recently completed basic compliance training, with minimal senior review, to expedite the process. The correct answer is C. Implementing a tiered due diligence system where enhanced due diligence is only applied to clients explicitly flagged as high risk by an automated system, and standard due diligence is deemed sufficient for all others, even if initial risk indicators suggest otherwise. Explanation. Scenario analysis. This scenario presents a challenge in balancing the need for efficient client onboarding with the regulatory imperative to conduct thorough know-your-customer (KYC) and anti-money laundering (AML) checks. The pressure to onboard clients quickly, driven by market research indicating a competitive advantage, can lead to shortcuts that compromise compliance. Professionals must exercise sound judgment to ensure that speed does not come at the expense of regulatory adherence, which carries significant reputational and financial risks. Correct approach analysis. The correct approach prioritizes robust KYC/AML procedures, even if it means a slightly longer onboarding time. This aligns with the fundamental principles of financial regulation, which mandate that firms understand their clients and the risks associated with their transactions to prevent financial crime. Adhering to these procedures is not merely a procedural step, but a critical component of maintaining the integrity of the financial system and protecting the firm from regulatory sanctions, fines, and reputational damage. This approach demonstrates a commitment to compliance and responsible business conduct. Incorrect approaches analysis. One incorrect approach involves relying solely on client self-declarations for sensitive information without independent verification. This fails to meet the due diligence requirements of KYC/AML regulations, which necessitate reasonable steps to verify customer identity and the source of funds. Such a failure exposes the firm to the risk of facilitating money laundering or terrorist financing, leading to severe regulatory penalties. Another incorrect approach is to delegate the entire KYC/AML process to junior staff without adequate training or oversight. While delegation can be efficient, regulatory responsibilities for compliance remain with the firm. Inadequate training can lead to errors, omissions, and a superficial understanding of the risks, undermining the effectiveness of the controls and potentially resulting in noncompliance. A third incorrect approach is to bypass enhanced due diligence (ED) for clients identified as high risk, based on the assumption that they are unlikely to engage in illicit activities. This directly contravenes regulatory expectations for EDD, which are specifically designed to address the increased risks posed by certain clients or transactions. Failing to apply EDD to high-risk clients is a clear breach of regulatory requirements and significantly increases the firm's exposure to financial crime. Professional reasoning. Professionals should adopt a risk-based approach to client onboarding. This involves identifying and assessing the risks associated with each client and applying appropriate controls. While efficiency is desirable, it should never compromise regulatory obligations. A decision-making framework should include 1. Understanding the specific regulatory requirements for KYC/AML in the relevant jurisdiction. 2. Assessing the risk profile of each client. 3. Implementing proportionate due diligence measures, including EDD where necessary. 4. Ensuring adequate training and oversight of staff. And 5. Maintaining robust record-keeping and reporting mechanisms. When faced with pressure to expedite processes, professionals must advocate for compliance, highlighting the potential consequences of regulatory breaches. Question 8. The evaluation methodology shows a financial advisory firm is implementing a new client onboarding system designed to enhance data security and streamline client information gathering. The implementation team is considering several strategies to roll out this new system. Which of the following strategies best balances operational efficiency with strict adherence to regulatory requirements and ethical client service standards? Option A. An immediate firm-wide deployment of the new system, prioritizing speed to market and assuming staff will adapt quickly to the changes with minimal formal instruction. Option B. A comprehensive, multi-stage rollout that includes extensive staff training, pilot testing with a small group of clients, and a robust feedback collection mechanism for continuous improvement. Option C. A partial implementation where only certain client segments are onboarded using the new system, while existing clients continue with the old process, with a plan to update the old system later. Option D. A strategy that focuses on the technical aspects of the system's functionality, with minimal emphasis on staff training or client communication to avoid delays. The correct answer is B. A comprehensive, multi-stage rollout that includes extensive staff training, pilot testing with a small group of clients, and a robust feedback collection mechanism for continuous improvement. Explanation. The evaluation methodology shows a scenario where a financial advisor is tasked with implementing a new client onboarding process. This is professionally challenging because it requires not only understanding the technical aspects of the new process, but also ensuring its seamless integration into daily operations while adhering to all relevant regulatory requirements. The advisor must balance efficiency with compliance, and potential resistance from existing staff or unforeseen technical glitches can complicate implementation. Careful judgment is required to anticipate these challenges and develop mitigation strategies. The correct approach represents best professional practice because it prioritizes a phased rollout, comprehensive training, and continuous feedback mechanisms. This aligns with regulatory expectations for robust internal controls and client protection. Specifically, a phased rollout allows for early identification and correction of issues, minimizing disruption and potential client harm. Thorough training ensures that all staff understand their responsibilities under the new process and relevant regulations, reducing the risk of non-compliance. Establishing feedback channels allows for ongoing refinement, ensuring the process remains effective and compliant over time. This proactive and iterative approach demonstrates a commitment to both operational excellence and regulatory adherence, which are paramount in the financial services industry. An incorrect approach that focuses solely on rapid implementation without adequate training or testing would be professionally unacceptable. This would likely lead to errors in client data capture, misrepresentation of services, or breaches of data privacy regulations, such as those under the JBS hiring assessment test's specified jurisdiction. Such failures could result in significant regulatory penalties, reputational damage, and loss of client trust. Another incorrect approach that bypasses established compliance checks in favor of perceived efficiency would be a direct violation of regulatory mandates. This demonstrates a disregard for the principles of integrity and due diligence, which are foundational to professional conduct. It exposes the firm and its clients to undue risk and could lead to severe disciplinary actions from regulatory bodies. A third incorrect approach that neglects to document the implementation process or gather feedback would hinder future audits and improvements. This lack of transparency and accountability is contrary to regulatory requirements for record-keeping and continuous improvement of internal systems. It makes it difficult to demonstrate compliance retrospectively and to learn from implementation challenges. Professionals should adopt a decision-making framework that begins with a thorough understanding of the regulatory landscape and the specific requirements of the new process. This should be followed by a risk assessment to identify potential implementation challenges and their impact on compliance and client service. Developing a detailed implementation plan that includes training, testing, and feedback loops is crucial. Regular review and adaptation of the plan based on feedback and performance data are essential for successful and compliant implementation. Question 9. Process analysis reveals that a recent regulatory update concerning client suitability assessments requires significant changes to how financial advisors evaluate and document client risk tolerance and investment objectives. The firm needs to ensure all client-facing staff are fully compliant with these new requirements by the upcoming deadline. Which of the following implementation strategies best addresses this challenge? Option A. Organize a series of informal brown bag lunch sessions where department heads can field questions as they arise from staff reviewing the new policy. Option B. Distribute the updated regulatory policy document to all relevant staff via email, with a mandatory acknowledgement of receipt. Option C. Empower each team leader to independently train their respective teams on the new requirements, allowing for flexibility in approach based on team needs. Option D. Develop and deliver a comprehensive training program that includes detailed policy review, practical case studies, interactive workshops, and a post-training assessment to gauge understanding and application. Establish a dedicated internal helpline for immediate clarification on complex scenarios and schedule follow-up refresher sessions. The correct answer is D. Develop and deliver a comprehensive training program that includes detailed policy review, practical case studies, interactive workshops, and a post-training assessment to gauge understanding and application. Establish a dedicated internal helpline for immediate clarification on complex scenarios and schedule follow-up refresher sessions. Explanation. This scenario presents a common implementation challenge in financial services, ensuring that new regulatory requirements are not just understood, but effectively integrated into daily operations and client interactions. The challenge lies in translating abstract rules into concrete actions and ensuring staff competency. Careful judgment is required to balance the urgency of compliance with the need for thoroughness and minimal disruption to client service. The correct approach represents best professional practice because it prioritizes a structured, multifaceted training program that goes beyond mere information dissemination. It emphasizes practical application, ongoing reinforcement, and clear communication channels. This aligns with regulatory expectations for robust compliance frameworks, which demand not only awareness, but also demonstrable understanding and adherence to rules. Ethically, it demonstrates a commitment to client protection and fair dealing by ensuring staff are equipped to provide accurate advice and services. An incorrect approach that focuses solely on distributing policy documents fails to address the practical implementation and understanding gap. This is a regulatory failure because it does not ensure staff can apply the rules correctly, potentially leading to breaches. Ethically, it falls short of the duty of care owed to clients. Another incorrect approach, which relies on ad hoc queue and accessions without a structured curriculum, is also a regulatory failure. It lacks consistency and may lead to misinformation or incomplete understanding, increasing the risk of noncompliance. Ethically, it is insufficient to equip staff with the necessary knowledge. A third incorrect approach, which delegates the entire responsibility to individual teams without central oversight or standardized training, creates significant compliance risk. This is a regulatory failure due to the lack of a cohesive and verifiable compliance effort across the organization. Ethically, it can lead to inconsistent client treatment and a breakdown in accountability. Professionals should use a decision-making framework that begins with a clear understanding of the regulatory objective. This involves identifying the specific behaviors and processes that need to change. Next, they should assess the current state of staff knowledge and operational procedures. Based on this assessment, a comprehensive training and implementation plan should be developed, incorporating various learning methods and assessment tools. Regular monitoring and feedback mechanisms are crucial to ensure ongoing compliance and to identify areas for further refinement. Question 10. System analysis indicates that a new trading platform is being developed with advanced algorithmic trading capabilities. To ensure adherence to all relevant financial regulations and data privacy laws, what is the most prudent approach to implementation? Option A. Rely on the vendor's certification that the platform meets all applicable regulatory standards with minimal internal review. Option B. Prioritize the rapid deployment of the platform to gain a competitive advantage, with compliance checks to be performed on a post-implementation basis as resources allow. Option C. Defer all compliance validation until after the platform has been fully deployed and is operational. Option D. Conduct a comprehensive regulatory impact assessment and integrate compliance testing into all phases of the development and testing lifecycle, including user acceptance testing and pre-deployment reviews. Correct answer is D. Conduct a comprehensive regulatory impact assessment and integrate compliance testing into all phases of the development and testing lifecycle, including user acceptance testing and pre-deployment reviews. Explanation. Scenario analysis. This scenario presents a common implementation challenge in financial services. balancing the need for efficient data processing with the imperative to comply with evolving regulatory requirements. The challenge lies in the potential for a new system to inadvertently create or exacerbate compliance gaps, particularly concerning data privacy and reporting obligations. Professionals must exercise careful judgment to ensure that technological advancements do not compromise established legal and ethical standards. The pressure to deploy new systems quickly can sometimes lead to overlooking critical compliance checks, making a robust implementation strategy essential. Correct approach analysis. The correct approach involves a proactive and integrated compliance review throughout the system development lifecycle. This aligns with the principles of compliance by design and privacy by design, which are increasingly embedded in regulatory frameworks. Specifically, it reflects the spirit of regulations that mandate robust risk management and adherence to data protection laws. By conducting a thorough impact assessment and integrating compliance checks into the testing phases, the firm demonstrates due diligence and a commitment to upholding its regulatory obligations. This approach ensures that potential compliance issues are identified and remediated before the system goes live, thereby mitigating legal and reputational risks. It also reflects best practices in operational resilience and governance. Incorrect approach is analysis. One incorrect approach is to defer compliance validation until after the system is operational. This represents a significant regulatory failure. Many regulations, such as those governing data handling and financial reporting, require pre-implementation assessments and ongoing monitoring. Post-implementation validation increases the risk of non-compliance, potentially leading to fines, sanctions, and reputational damage. It demonstrates a reactive rather than a proactive stance towards regulatory adherence. Another incorrect approach is to assume that the new systems vendor has already ensured full compliance. While vendors are responsible for the compliance of their products, the ultimate responsibility for compliance within a regulated entity rests with that entity. Relying solely on vendor assurances without independent verification is a breach of due diligence and regulatory expectations. This can lead to overlooking jurisdiction-specific requirements or nuances that the vendor may not have fully addressed. A third incorrect approach is to prioritize system functionality and speed of deployment over comprehensive compliance testing. This demonstrates a disregard for regulatory mandates and ethical responsibilities. Regulations are not optional, they are legal requirements. Sacrificing compliance for expediency can result in severe penalties and undermine the integrity of the firm's operations and client trust. It signals a culture that does not adequately value regulatory adherence. Professional reasoning. Professionals should adopt a risk-based approach to system implementation. This involves identifying potential compliance risks early in the project lifecycle, assessing their likelihood and impact, and developing mitigation strategies. A key decision-making framework involves integrating compliance and legal teams into the project from its inception. Regular checkpoints should be established to review progress against compliance requirements. When faced with trade-offs between functionality and compliance, the regulatory and ethical imperative must always take precedence. Professionals should document all compliance assessments and decisions, creating an audit trail that demonstrates due diligence and adherence to established procedures and regulations. Question 11. Operational review demonstrates that a high-value client, whose business activities are complex and involve international transactions, has recently engaged in a series of cash deposits that, while individually below the reporting threshold, collectively appear unusual given their stated business model and historical transaction patterns. The client has also become increasingly evasive when asked for clarification on the source of these funds. What is the most appropriate immediate next step for the firm? Option A. Initiate a thorough internal investigation, gathering all available transaction data and client information, and consult with the firm's compliance and legal departments to assess whether a suspicious activity report (SAR) is warranted. Option B. Advise the client that their recent transaction activity is raising concerns and suggest they provide further documentation to avoid potential regulatory scrutiny. Option C. Continue to monitor the client's activity without further action, given the client's importance to the firm and the absence of any single transaction exceeding the reporting threshold. Option D. Immediately file a suspicious activity report (SAR) with the relevant regulatory authority based on the unusual deposit patterns and client evasiveness. The correct answer is A. Initiate a thorough internal investigation, gathering all available transaction data and client information, and consult with the firm's compliance and legal departments to assess whether a suspicious activity report (SAR) is warranted. Explanation. This scenario presents a professional challenge due to the inherent tension between client confidentiality and the need to comply with regulatory reporting obligations. The firm must navigate a situation where a client's actions, while not explicitly illegal on their face, raise significant concerns that could indicate involvement in illicit activities. The challenge lies in balancing the duty of loyalty to the client with the broader responsibility to maintain the integrity of the financial system and prevent financial crime, as mandated by regulatory frameworks. Careful judgment is required to assess the materiality of the concerns without overstepping into unfounded accusations or breaching client trust unnecessarily. The correct approach represents best professional practice because it prioritizes a thorough, documented, and objective internal assessment before taking any external action. This aligns with the principles of responsible financial conduct and regulatory compliance. By gathering all available information and consulting with internal compliance and legal teams, the firm ensures that any subsequent reporting is based on a well-founded suspicion, not mere conjecture. This process minimizes the risk of unwarranted reporting, which could damage client relationships and the firm's reputation, while still fulfilling the obligation to report suspicious activities if the assessment warrants it. This methodical approach is a cornerstone of robust anti-money laundering (AML) and counter-terrorist financing (CTF) frameworks. An incorrect approach that involves immediate reporting without internal investigation fails to uphold the principle of proportionality and due diligence. It could lead to the filing of frivolous suspicious activity reports (SAR), which constrain regulatory resources and potentially harm innocent clients. This approach demonstrates a lack of professional judgment and a failure to adequately assess the situation, potentially violating internal policies and ethical guidelines regarding client care and the responsible use of reporting mechanisms. Another incorrect approach, which is to ignore the concerns due to the client's importance or potential business loss, represents a severe regulatory and ethical failure. This directly contravenes AML/CTF regulations that mandate reporting of suspicious activities, regardless of the client's status or the potential financial implications for the firm. Such an action could facilitate financial crime and expose the firm to significant penalties, reputational damage, and legal repercussions. It signifies a dereliction of duty and a prioritization of profit over regulatory compliance and societal safety. A third incorrect approach, which is to subtly hint to the client about the concerns without formal reporting, is also professionally unacceptable. This is an indirect and often ineffective way to address the issue and can be interpreted as an attempt to circumvent formal reporting obligations. It does not provide regulators with the necessary information for investigation and could be seen as complicity or an attempt to manage the situation outside of established compliance procedures. This approach lacks transparency and accountability. The professional decision-making process for similar situations should involve a structured risk-based approach. First, identify and assess the potential risks and regulatory obligations. Second, gather all relevant facts and information objectively. Third, consult with internal compliance, legal, and senior management to ensure a comprehensive understanding of the situation and potential courses of action. Fourth, document all assessments, decisions, and actions meticulously. Finally, act in accordance with regulatory requirements and ethical principles, prioritizing the integrity of the financial system and the firm's compliance obligations. Question 12. The monitoring system demonstrates a pattern of unusual, high-frequency, small-value transactions initiated by a client, which, while individually below reporting thresholds, collectively suggest a potential attempt to circumvent standard anti-money laundering protocols. The client has expressed frustration with previous delays in processing similar transactions and has explicitly requested that the firm just process them quickly without asking too many questions this time. What is the most appropriate course of action for the financial advisor? Option A. Immediately escalate the situation to the compliance department for further investigation and guidance, while informing the client that the firm must adhere to its established procedures to ensure their account security and regulatory compliance. Option B. Attempt to find a technical loophole or alternative processing method that allows the transactions to be completed quickly without triggering the monitoring system's alerts, while still appearing to follow the letter of the law. Option C. Advise the client that the firm cannot accommodate their request due to internal policy and suggest they seek financial services elsewhere if they are unwilling to comply with the firm's procedures. Option D. Process the transactions as requested by the client to avoid further client dissatisfaction and potential loss of business, assuming the individual amounts are not suspicious on their own. The correct answer is A. Immediately escalate the situation to the compliance department for further investigation and guidance, while informing the client that the firm must adhere to its established procedures to ensure their account security and regulatory compliance. Explanation. Scenario analysis. This scenario presents a professional challenge due to the conflict between a client's explicit instructions and the firm's internal ethical guidelines and regulatory obligations. The advisor must navigate the potential for client dissatisfaction if their wishes are not accommodated, while simultaneously upholding their fiduciary duty and adhering to compliance procedures designed to protect both the client and the firm from undue risk. The pressure to maintain client relationships can create a temptation to overlook or downplay potential ethical breaches. Correct approach analysis. The correct approach involves a thorough, documented discussion with the client, clearly explaining the firm's policies and the regulatory reasons behind them. This demonstrates transparency and a commitment to acting in the client's best interest, even if it means disagreeing with their initial request. By offering alternative compliance solutions, the advisor upholds their fiduciary duty, adheres to regulatory requirements, such as those pertaining to suitability and anti-money laundering, depending on the specific context of the JBS assessment, and maintains professional integrity. This approach prioritizes client protection and regulatory compliance, which are paramount in financial services. Incorrect approaches analysis. One incorrect approach involves proceeding with the client's request without further inquiry or discussion. This directly violates regulatory obligations that mandate due diligence and suitability assessments. It could expose the client to inappropriate risks and the firm to significant penalties for noncompliance. Ethically, it represents a failure to act in the client's best interest by not ensuring the proposed action aligns with their overall financial situation and risk tolerance. Another incorrect approach is to dismiss the client's request outright without attempting to understand their underlying motivations or offering compliant alternatives. While adhering to policy is important, a complete lack of engagement can damage the client relationship and may indicate a failure to explore legitimate client needs that could be met through alternative, acceptable means. This approach lacks the professional nuance required to balance client service with regulatory adherence. A third incorrect approach is to seek a workaround that technically bypasses the firm's policy, but still facilitates the client's original, potentially problematic, request. This is a serious ethical and regulatory breach, as it demonstrates a deliberate attempt to circumvent established controls. It undermines the integrity of the firm's compliance framework and could lead to severe disciplinary action and reputational damage. Professional reasoning. Professionals should employ a decision-making framework that prioritizes understanding the client's needs, assessing them against regulatory requirements and firm policies, and then communicating transparently. When a conflict arises, the process involves 1. Active listening, understand the client's objective. 2. Regulatory and policy review, determine if the request aligns with all applicable rules and internal guidelines. 3. Risk assessment, evaluate potential risks to the client and the firm. 4. Transparent communication, clearly explain any limitations or concerns to the client. 5. Solution exploration, propose compliant alternatives that meet the client's underlying needs. 6. Documentation, record all discussions and decisions. Question 13. Assessment of a financial advisor's ethical response when discovering a client has provided falsified documents to secure a loan, and the advisor suspects this may be part of a larger scheme to defraud the lending institution. Option A. Confront the client directly with the findings and request an explanation, advising them to rectify the situation before considering any further action. Option B. Immediately report the falsified documents and suspected fraudulent activity to the relevant regulatory authorities and the firm's compliance department, while maintaining client confidentiality to the extent legally permissible during the reporting process. Option C. Disregard the falsified documents as a minor oversight by the client and proceed with the loan application, assuming the lending institution will conduct its own due diligence. Option D. Inform the client that the discovered falsification will be reported to the lending institution, but refrain from reporting to regulatory authorities unless directly instructed to do so. The correct answer is B. Immediately report the falsified documents and suspected fraudulent activity to the relevant regulatory authorities and the firm's compliance department, while maintaining client confidentiality to the extent legally permissible during the reporting process. Explanation: this scenario presents a professional challenge due to the inherent conflict between client confidentiality and the obligation to report potential financial misconduct. The firm's reputation, client trust, and adherence to regulatory standards are all at stake. The professional must navigate these competing interests with integrity and a clear understanding of their duties. The correct approach prioritizes regulatory compliance and the integrity of the financial system. By reporting the suspicious activity to the relevant authorities, the professional upholds their duty to prevent financial crime and protect the broader market. This aligns with the principles of professional conduct that emphasize honesty, integrity, and the public interest, as mandated by the JBS Hiring Assessment Tests regulatory framework, which likely includes provisions for reporting suspicious transactions to prevent money laundering and other financial crimes. This proactive reporting demonstrates a commitment to ethical practice and regulatory adherence, safeguarding both the firm and the financial ecosystem. An incorrect approach that involves ignoring the suspicious activity or downplaying its significance would be a severe ethical and regulatory failure. This inaction could be construed as complicity in potential financial misconduct, violating the duty to report and potentially exposing the firm to significant penalties and reputational damage. Furthermore, it undermines the trust placed in financial professionals to act as gatekeepers against illicit activities. Another incorrect approach, such as confronting the client directly without first consulting with compliance or legal departments, could jeopardize the investigation, alert the potential wrongdoer, and potentially lead to the destruction of evidence. This bypasses established internal procedures designed to handle such sensitive matters effectively and in accordance with regulatory requirements. It also risks creating a conflict of interest and could expose the professional to personal liability. The professional decision-making process in such situations should involve a structured approach. 1. Identify the potential issue and its implications. 2. Consult internal policies and procedures, particularly those related to suspicious activity reporting and client confidentiality. 3. Seek guidance from the firm's compliance or legal department. 4. If the situation warrants, follow the established protocol for reporting to the appropriate regulatory bodies. 5. Document all actions taken and decisions made. This systematic process ensures that actions are taken in a compliant, ethical, and effective manner, minimizing risk and upholding professional standards. Question 14. Comparative studies suggest that financial advisors often face situations where a client's immediate request may not align with their long-term financial well-being. Imagine you are advising a long-term client who has recently expressed a strong desire to liquidate a significant portion of their diversified investment portfolio to fund a speculative, high-risk venture that has been heavily promoted by a friend. The client appears enthusiastic, but has provided limited details about the venture's operational plan or financial projections. What is the most appropriate course of action? Option A. Immediately contact the client's friend to gather more information about the speculative venture before discussing it further with the client. Option B. Gently but firmly refuse the client's request, explaining that you cannot in good conscience facilitate an investment you deem too risky for their profile. Option C. Proceed with the liquidation as requested, documenting the client's instructions and acknowledging their understanding of the risks involved. Option D. Engage in a detailed discussion with the client to understand their motivations, thoroughly research the proposed venture, and explore alternative strategies that might meet their objectives while managing risk. The correct answer is C. Proceed with the liquidation as requested, documenting the client's instructions and acknowledging their understanding of the risks involved. Explanation: this scenario presents a professional challenge due to the inherent conflict between a client's stated wishes and the potential for that client to be unduly influenced or to make decisions that are not in their best long-term interest. The requirement for careful judgment stems from the advisor's fiduciary duty and the need to balance client autonomy with the obligation to act in the client's best interests, particularly when dealing with potentially vulnerable individuals or complex financial situations. The correct approach represents best professional practice because it prioritizes a thorough understanding of the client's situation and motivations before acting on their instructions. This aligns with regulatory frameworks that mandate suitability assessments and a duty of care. It involves open communication, seeking clarification, and exploring alternatives, ensuring that any decision is informed and truly reflects the client's genuine, uncoerced intentions. This proactive and investigative stance upholds ethical principles of integrity and competence. An incorrect approach that immediately executes the client's request without further inquiry fails to uphold the duty of care. It risks facilitating a decision that could be detrimental to the client, potentially leading to regulatory breaches related to suitability and client protection. Another incorrect approach, that of dismissing the client's request outright due to perceived personal judgment, oversteps the advisor's role and infringes upon client autonomy, potentially violating principles of respect and fair dealing. A third incorrect approach, focusing solely on minimizing personal liability without adequately addressing the client's needs, demonstrates a lack of professional integrity and a failure to prioritize the client's welfare, which is a cornerstone of regulatory compliance and ethical conduct. Professionals should employ a decision-making framework that begins with active listening and information gathering. This should be followed by critical analysis of the information, considering potential risks and benefits for the client. If there are concerns about the client's capacity or the suitability of the request, the professional should engage in further dialogue, seek clarification, and explore alternative solutions. Escalation to a supervisor or compliance department should be considered if significant ethical or regulatory concerns persist. The ultimate goal is to ensure that any action taken is in the client's best interest and fully compliant with all applicable regulations and ethical standards. Question 15. Strategic planning requires a firm to anticipate and address potential ethical dilemmas. Imagine a situation where a senior analyst, while conducting due diligence for a potential merger, discovers credible evidence suggesting that the target company is engaged in systematic financial misrepresentation that could lead to significant investor losses and potential regulatory violations. The analyst is bound by a duty of confidentiality to the client commissioning the due diligence. What is the most appropriate course of action for the analyst? Option A. Discreetly resign from the engagement without disclosing the reason for departure to avoid any personal or firm liability. Option B. Immediately report the findings to the relevant regulatory authorities and the client, while also seeking guidance from the firm's legal counsel on how to proceed with confidentiality obligations. Option C. Inform the target company's management about the findings and give them an opportunity to rectify the situation before reporting it to anyone else. Option D. Continue with the due diligence process as planned, assuming the client will uncover any issues during their own review and maintain strict confidentiality regarding the discovered misrepresentation. The correct answer is B. Immediately report the findings to the relevant regulatory authorities and the client, while also seeking guidance from the firm's legal counsel on how to proceed with confidentiality obligations. Explanation. This scenario presents a professional challenge due to the inherent conflict between a firm's commitment to client confidentiality and the potential need to disclose information that could prevent significant harm. The firm's reputation, client trust, and legal obligations are all at stake. Careful judgment is required to balance these competing interests. The correct approach, which involves seeking legal counsel and potentially reporting the matter through appropriate channels while respecting client confidentiality as much as possible, represents best professional practice. This aligns with regulatory frameworks that often mandate reporting of certain illegal activities or threats, while also upholding ethical duties to clients. It demonstrates a commitment to both legal compliance and professional integrity. An incorrect approach that prioritizes absolute client confidentiality without considering the potential harm would be a regulatory and ethical failure. It could lead to complicity in illegal activities and a breach of professional duty to protect the public interest. Another incorrect approach, which involves immediate and unqualified disclosure without proper investigation or legal advice, could violate client confidentiality agreements and potentially lead to legal repercussions for the firm and its employees, as well as damage client relationships. Professionals should employ a decision-making framework that begins with identifying the ethical and regulatory obligations. This involves consulting relevant codes of conduct, laws, and firm policies. Next, they should gather all relevant facts and assess the potential risks and consequences of each possible course of action. Seeking advice from senior management, legal counsel, or compliance officers is crucial. Finally, the decision should be documented, and the chosen course of action implemented with diligence and transparency where appropriate. Question 16. To address the challenge of a client disclosing information about potentially fraudulent accounting practices that could lead to significant financial repercussions for their company and its stakeholders, what is the most appropriate initial course of action for a financial advisor? Option A. Directly report the suspected fraudulent activity to the relevant regulatory authorities without informing anyone within the firm. Option B. Immediately escalate the concern to the firm's compliance department and senior management for guidance and to follow established internal procedures. Option C. Advise the client to cease all business operations immediately to mitigate potential legal exposure. Option D. Ignore the information provided by the client, assuming it is a hypothetical scenario or an exaggeration. The correct answer is B. Immediately escalate the concern to the firm's compliance department and senior management for guidance and to follow established internal procedures. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the potential for harm to others. The financial advisor is privy to information that, if acted upon, could lead to significant financial distress for the client's business and potentially impact its employees and suppliers. However, the advisor also has a professional and ethical obligation to act with integrity and in the best interests of their clients, which includes maintaining confidentiality. The difficulty lies in balancing these competing duties. The correct approach represents best professional practice because it prioritizes a structured, ethical, and legally compliant process. By seeking guidance from senior management and the compliance department, the advisor is adhering to internal policies and regulatory frameworks designed to handle such sensitive situations. This ensures that any action taken is well considered, documented, and aligned with legal and ethical standards, such as those governing client confidentiality and the duty to report potential misconduct or significant risks. This approach upholds the principles of professional integrity and responsible conduct. An incorrect approach of immediately reporting the information to external authorities without internal consultation would breach client confidentiality, a fundamental ethical and often legal obligation. This could lead to severe reputational damage for the advisor and their firm, as well as potential legal repercussions for violating client trust. Another incorrect approach of ignoring the information, despite its potential severity, fails to uphold the advisor's duty of care and could lead to greater harm if the situation deteriorates. This inaction could be seen as a dereliction of professional duty. A third incorrect approach of confronting the client directly and demanding a specific course of action without proper internal review could escalate the situation unnecessarily, damage the client relationship, and bypass established procedures for risk management and ethical decision-making. Professionals should employ a decision-making framework that begins with identifying the ethical and regulatory considerations. This involves understanding the relevant codes of conduct, internal policies, and legal obligations. Next, they should gather all relevant facts and assess the potential impact of different courses of action. Seeking advice from supervisors, compliance officers, or legal counsel is crucial when faced with complex ethical dilemmas. Documenting the decision-making process and the rationale behind the chosen course of action is also essential for accountability and review. Question 17. Benchmark analysis indicates that a hiring manager has requested specific, predetermined interpretations of candidate scores from a JBS hiring assessment test, intending to use these interpretations to justify a pre-decided hiring outcome rather than for objective evaluation. What is the most ethically and regulatorily sound approach for the professional administering or interpreting the assessment? Option A. Offer a generalized summary of candidate performance without addressing the specific score interpretations requested, hoping to satisfy the manager without compromising integrity. Option B. Provide the hiring manager with the predetermined interpretations they requested, as their instructions as the hiring manager should be followed. Option C. Refuse to engage further with the hiring manager, citing strict confidentiality and the inability to discuss assessment results in any context. Option D. Politely explain to the hiring manager the purpose of the assessment is for objective evaluation and that predetermined interpretations are inappropriate, offering to discuss how the assessment results can be used to inform their decision-making process in a fair and unbiased manner. The correct answer is D. Politely explain to the hiring manager the purpose of the assessment is for objective evaluation and that predetermined interpretations are inappropriate, offering to discuss how the assessment results can be used to inform their decision-making process in a fair and unbiased manner. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's explicit, albeit potentially misguided, instructions and the professional's duty of care and regulatory obligations. The challenge lies in navigating the client's autonomy while upholding ethical standards and ensuring compliance with the JBS hiring assessment test's regulatory framework. The professional must balance client satisfaction with the integrity of the assessment process and the potential for misinterpretation or misuse of results. Correct approach analysis. The correct approach involves seeking clarification and educating the client on the purpose and limitations of the assessment. This upholds best professional practice by prioritizing accurate and ethical use of the JBS hiring assessment test. It aligns with the regulatory framework's emphasis on ensuring assessments are administered and interpreted appropriately, preventing potential misuse or misrepresentation of candidate suitability. This approach demonstrates professional integrity and a commitment to the assessment's validity. Incorrect approaches analysis. One incorrect approach involves directly complying with the client's request without further inquiry. This fails to uphold the professional's duty of care and could lead to the misapplication of assessment results, potentially violating the spirit and letter of the JBS hiring assessment test's guidelines regarding appropriate use. It prioritizes client instruction over professional judgment and regulatory compliance. Another incorrect approach is to refuse to provide any information or assistance, citing confidentiality without attempting to understand the client's underlying need. While confidentiality is crucial, an outright refusal without exploring the situation can be unprofessional and may not be strictly required by the JBS hiring assessment test's framework if the client is seeking legitimate clarification. A third incorrect approach is to provide a superficial explanation that does not adequately address the client's potential misunderstanding or the nuances of the assessment. This can leave the client with incomplete or misleading information, still risking the misuse of the assessment results and failing to meet the professional's obligation to ensure proper understanding. Professional reasoning. Professionals should adopt a decision-making process that begins with active listening to understand the client's request and underlying intent. This should be followed by an assessment of the request against professional ethical codes and the specific regulatory framework, JBS hiring assessment test. If a conflict or potential for misuse is identified, the next step is to seek clarification and provide education, explaining the rationale behind professional recommendations and regulatory requirements. Documentation of all interactions and decisions is also a critical component of professional practice. Question 18. The assessment process reveals that a highly productive team member, who is also a close friend of the candidate, has been observed consistently exaggerating performance metrics in client reports to create a more favorable impression. The candidate is aware of this behavior, but has not reported it. The candidate is now being asked to comment on their understanding of professional responsibility in such situations. Option A. Develop a rationale that explains how the colleague's reporting methods, while unconventional, ultimately serve the client's best interests by highlighting positive trends. Option B. Continue to monitor the situation without immediate action, believing that the colleague's overall performance justifies overlooking minor reporting discrepancies. Option C. Discreetly advise the colleague to correct their reporting practices in the future, assuming the issue is a minor oversight that can be resolved informally. Option D. Report the observed behavior to the appropriate internal compliance or management channels, initiating a formal review process to ensure client interests and regulatory adherence are protected. Correct answer is D. Report the observed behavior to the appropriate internal compliance or management channels, initiating a formal review process to ensure client interests and regulatory adherence are protected. Explanation. This scenario presents a professional challenge due to the inherent conflict between a firm's obligation to maintain client confidentiality and the need to address potential misconduct that could harm clients or the firm's reputation. The pressure to protect a colleague, especially one who is performing well, can cloud judgment. Careful consideration of ethical principles and regulatory requirements is paramount. The correct approach represents best professional practice because it prioritizes the firm's duty to its clients and adherence to regulatory standards over personal loyalty or avoidance of conflict. By reporting the observed behavior through the appropriate channels, the individual initiates a formal review process that can lead to a fair investigation and, if necessary, corrective action. This aligns with the principles of integrity, professionalism, and client care expected under the JBS hiring assessment tests implied regulatory framework, which would likely emphasize robust internal controls and a commitment to ethical conduct. An incorrect approach of ignoring the behavior fails to uphold the professional duty to act with integrity and may expose clients to risk. This inaction could be construed as a breach of professional conduct, potentially violating regulations that require reporting of suspicious activities or unethical behavior. Another incorrect approach, confronting the colleague directly without involving management or compliance, bypasses established internal procedures. While seemingly proactive, it risks escalating the situation inappropriately, potentially leading to a cover-up or further ethical breaches, and fails to leverage the firm's established mechanisms for addressing such issues, which are designed to ensure fairness and compliance. A third incorrect approach, fabricating a justification for the colleague's actions, is a direct ethical and regulatory violation. This constitutes dishonesty and a deliberate attempt to mislead, undermining the trust placed in professionals and potentially exposing the firm and its clients to significant harm. Professionals should employ a decision-making framework that begins with identifying the ethical and regulatory implications of a situation. This involves understanding the firm's code of conduct, relevant professional standards, and any applicable laws or regulations. When faced with a potential ethical dilemma, the next step is to gather objective facts, avoiding assumptions or emotional responses. Then consider the potential consequences of different actions on all stakeholders, including clients, colleagues, the firm, and oneself. Consulting with a trusted senior colleague, mentor, or the firm's compliance department can provide valuable perspective and guidance. Ultimately, the decision should align with the highest ethical standards and regulatory requirements, prioritizing client welfare and the integrity of the profession. Question 19. Benchmark analysis indicates that the current candidate screening process is taking longer than industry averages, leading to a potential loss of top talent. To address this, a team proposes implementing a new automated resume parsing tool that promises to significantly reduce initial screening time. However, concerns have been raised about the potential for this tool to misinterpret nuanced qualifications or introduce algorithmic bias. Considering the JBS hiring assessment test framework, which of the following represents the most responsible and compliant approach to process optimization? Option A. Conduct a pilot program with a diverse candidate pool to rigorously test the new automated tool's accuracy, fairness, and impact on assessment validity before full implementation, while simultaneously reviewing existing manual screening protocols for potential efficiencies that do not compromise quality. Option B. Focus solely on streamlining the manual review process by reducing the number of criteria evaluators consider, thereby speeding up individual assessments without introducing new technology. Option C. Immediately deploy the new automated resume parsing tool across all screening activities to achieve the fastest possible reduction in processing time, assuming that any initial inaccuracies can be corrected post-implementation. Option D. Implement the new automated tool and simultaneously reduce the depth of subsequent assessment stages to compensate for any perceived initial screening inefficiencies. The correct answer is A. Conduct a pilot program with a diverse candidate pool to rigorously test the new automated tool's accuracy, fairness, and impact on assessment validity before full implementation, while simultaneously reviewing existing manual screening protocols for potential efficiencies that do not compromise quality. Explanation. This scenario presents a professional challenge because it requires balancing the pursuit of efficiency gains with the imperative to maintain regulatory compliance and ethical conduct within the JBS hiring assessment test framework. The pressure to optimize processes, often driven by performance metrics, can inadvertently lead to shortcuts that compromise the integrity of assessments or the fairness of the hiring process. Careful judgment is required to identify and implement improvements that are both effective and compliant. The correct approach represents best professional practice because it prioritizes a thorough, data-driven review of existing processes before proposing changes. This aligns with the principles of responsible process optimization, ensuring that any proposed changes are well-founded, measurable, and do not introduce new risks. Specifically, it adheres to the implicit regulatory expectation within any hiring assessment framework to ensure fairness, validity, and reliability of the assessment tools and procedures. By focusing on identifying bottlenecks and inefficiencies through objective data, this approach minimizes the risk of implementing changes that could inadvertently disadvantage candidates or violate assessment standards. An incorrect approach that focuses solely on reducing the time taken for a specific assessment component, without validating its impact on assessment validity or fairness, would represent a significant regulatory and ethical failure. This could lead to a violation of principles of fair assessment, potentially discriminating against certain candidate profiles, or failing to accurately measure the required competencies. Another incorrect approach that involves bypassing established quality control checks in the name of speed would also be a failure, as it undermines the reliability and integrity of the assessment process, potentially leading to flawed hiring decisions and reputational damage. A third incorrect approach that prioritizes the adoption of new technologies without adequate pilot testing or consideration of their impact on candidate experience and data privacy would also be a failure, risking noncompliance with data protection regulations and potentially introducing bias through algorithmic limitations. Professionals should employ a decision-making framework that begins with understanding the objectives of process optimization, which should always include maintaining or enhancing the quality and fairness of the outcome. This involves gathering data, analyzing current performance against established benchmarks and regulatory requirements, identifying root causes of inefficiencies, and then developing and piloting potential solutions. The evaluation of any proposed solution must consider its impact on all relevant stakeholders, including candidates, hiring managers, and the organization, as well as its compliance with all applicable regulations and ethical guidelines. Continuous monitoring and feedback loops are essential to ensure that optimized processes remain effective and compliant over time. Question 20. Consider a scenario where a firm administering the JBS hiring assessment test is looking to optimize its internal processes to reduce turnaround time and operational costs. The firm is exploring several options to achieve this. Which of the following approaches best balances efficiency gains with the firm's regulatory obligations and ethical responsibilities? Option A. Implementing a phased rollout of new automated scoring mechanism, starting with a pilot group of assessments, accompanied by rigorous validation against existing manual scoring and continuous feedback from assessors and candidates to identify and address any discrepancies or issues before full deployment. Option B. Outsourcing the entire assessment administration and scoring process to a third-party vendor solely based on the lowest bid, without conducting due diligence on the vendor's compliance with the JBS hiring assessment test standards or their process optimization methodologies. Option C. Focusing exclusively on reducing the number of assessment components deemed non-essential for cost savings, without a thorough review of their impact on the overall validity and comprehensiveness of the assessment, as mandated by the JBS hiring assessment test guidelines. Option D. Immediately replacing all manual review stages with a fully automated system, assuming that technological advancements inherently improve efficiency and accuracy, without requiring extensive pre-implementation testing or ongoing monitoring. The correct answer is A. Implementing a phased rollout of new automated scoring mechanisms, starting with a pilot group of assessments, accompanied by rigorous validation against existing manual scoring and continuous feedback from assessors and candidates to identify and address any discrepancies or issues before full deployment. Explanation. This scenario presents a challenge in balancing efficiency gains with the potential for unintended consequences on client service and regulatory compliance. The core difficulty lies in identifying and implementing process improvements without compromising the firm's duty of care or adherence to the JBS hiring assessment test's regulatory framework. Careful judgment is required to ensure that optimization efforts do not inadvertently lead to a decline in the quality of assessments or create new compliance risks. The correct approach, focusing on a phased implementation with pilot testing and continuous feedback loops, represents best professional practice because it aligns with principles of responsible innovation and risk management. This method allows for the identification and mitigation of potential issues before a full rollout, ensuring that any changes are robust and compliant with the JBS hiring assessment test's guidelines. It demonstrates a commitment to both operational excellence and client welfare, a key ethical consideration. Furthermore, it allows for adaptation based on real-world performance, ensuring that the optimized processes remain effective and compliant over time. An incorrect approach that prioritizes immediate cost reduction through automation without thorough validation would represent a significant regulatory and ethical failure. Such an approach could lead to the introduction of biased assessment tools or the overlooking of critical assessment criteria, directly contravening the JBS hiring assessment test's requirements for fair and accurate evaluation. This would constitute a failure to uphold the duty of care owed to candidates and the employing organizations. Another incorrect approach, focusing solely on streamlining the administrative aspects of the assessment process without considering the impact on the assessment's integrity, would also be professionally unacceptable. This could result in a process that is faster but less thorough, potentially leading to inaccurate candidate profiling and undermining the validity of the assessment results. This failure stems from a lack of holistic process evaluation, neglecting the core purpose of the assessment itself. The professional decision-making process for similar situations should involve a comprehensive risk assessment of any proposed process change. This includes evaluating potential impacts on assessment quality, candidate experience, data integrity, and regulatory compliance. A structured approach, such as a pilot program followed by iterative refinement based on performance data and stakeholder feedback, is crucial. Professionals must always prioritize adherence to the JBS hiring assessment test's regulatory framework and ethical obligations over purely efficiency-driven objectives.